Hi everybody, and welcome back to video number 2 in chapter 16. And when we left off, we had finished this amortization table for the held to maturity example. Now, let's go back. Here, how would Uptown Financial record its first semi-annual interest payment on July 1, 2025? And Bravo, how should Uptown Financial record the accrual of interest and amortization of the bond discount on January 31, 2025? And then Charlie, how should Uptown report this information on its balance sheet at the end of the year 2025 and its income statement for 2025? All right, let's look at Alpha. How should they do the first semi-annual interest payment? And I think that's pretty straightforward. We're going to receive the cash for $4,000. That's what's written on the note. That's what we're going to get. Our debt investments are going to get reduced by $614. And that, we originally recorded that way back here at $92,278. So now we're going to add to that another $614. That's going to drive that debt investment up to $100,000 over the maturity life. And similarly, under Bravo, what we would do at the end of the year, we would just pick these numbers off of the bond amortization schedule. And I think you can see them here and here. And you can see the carrying amount of the bond is going to come up to $100,000 over the life of that bond. Okay, then under Charlie, they report its investment in GameStop's bonds in its December 31, 2025 statements as follows. Okay, on the balance sheet, we're going to record the interest receivable of $4,000 here. $4,000 here. And our long-term investments held to maturity of $93,537. As you will see, that's what the carrying amount would be at the end of 2025. And then on the income statement, we're going to record the two revenues that we received for the semi-annual interest payments here for $9,259. Okay. So what happens if we sell that security before maturity? Now, we're going to use the same facts that we did just previously, except that on November 1, 2 months before the actual maturity at December 31, or January 1, 2030 to be precise, we're going to sell it at 99 3/4 plus any accrued interest. And then, so what entry should it record to record the sale of those bonds on November 1, 2029? Well, first of all, we need to bring the discount up to speed. So we're going to do that by taking the $952. We'll go back to the amortization table and show you that. Here's the $952. And we're going to take that, but we're not getting it for the full term. We're only getting it for 4 of the 6 months. So we take 4/6 of $952, and that's $635. So we'll debit debt instruments, investments, and credit interest revenue for $635. Now, we're going to compute the gain on the sale of those securities as follows. The selling price was based on 99 3/4. So 100,000 times 0.9975 is equal to $99,750. But the book value of the bonds is 99,048 at July 1, and then we add that additional $635 here, and our book value then is $99,683 at November 1. And that means the difference between those two numbers is $67, which represents the gain on the sale of the bond. Now, the Uptown records the sale of the bond then as follows. We're going to receive $102,417. We get that by, we have our interest revenue, 4/6 of $4,000, what's written on the bond, $4,000. And our debt investment is going to be $99,683, which we calculated here. And then the gain on the sale of those investments here. All right, so I think you can follow the rest of that, and we'll move on. Okay, now we'll move to available for sale securities. This time we're reporting it on the balance sheet at the fair value, not the amortized cost. So the difference between fair value and amortized costs are recognized as unrealized holding gains or losses. And these unrealized holding gains or losses are reported in the other comprehensive income, not net income, right? And if we look down here, we're recognizing unrealized gains and losses is an application of the concept of comprehensive income. Okay, and then finally, for other comprehensive income is reported in the statement of comprehensive income and is added, or in some cases subtracted from, accumulated comprehensive income, which is reported as a separate component of stockholders' equity. Stockholders' equity. Even though it's income, it's part of equity here. So that's a little different than what you're used to, I believe. Okay, so the companies are going to report the available for sale securities at fair value. And bullet point 2, unrealized holding gains or losses are reported as other comprehensive income, a separate component of stockholders' equity until it's realized. Any discount or premium is amortized. Okay, let's take a look at an example. Here, the Graph Corporation purchases $100,000 10% 5-year bonds on January 1, 2024, with interest payable July 1 and January 1. The bonds sell for $108,111, which results in a premium of $8,111 and represents an effective interest rate of 8%. What entry should Graph make to record these bonds? So in this case, they're going to debit debt instruments, debt investments, and credit cash for $108,111. That looks like a good place for me to bounce back to our Excel spreadsheet, which of course is available in the modules, and you can see very quickly how we calculate that $108,111. Okay, here we are on the Excel spreadsheet for slide 19, which is very similar to slide 11. And here our annual rate is 8%, and we do exactly the same thing as we did before. if I change this to 10% real quickly, just to show you that's what's written on the bond, I have $5,000 of undiscounted cash. You can see that would be how we would value the bond if prevailing interest rates were 10%, but they're not. Prevailing interest rates are 8%. So as a result, our discounted cash flows total $108,110.90, rounded to 108,111. And we do it the same way as we did before here. We will take the present value of an annuity at $5,000 and the present value of our last $100,000 at 67, and that shows 108,111 with a gain here of $8,110.90. Okay, so as we go back to the PowerPoint slides, you can see how that 108,111 was calculated. Now, if we move on, here is the amortization table. We calculate that the same way, except that in this case, it's a gain. So when we do our carrying amount, you can see here that the carrying amount decreases over the maturity life of the bond to $100,000. Okay, calculated the same way. So now, if we refer back to that illustration 16.4, what entries do they make? Here, just like we did before, we're going to debit cash because we're receiving the cash, and we are correcting here for our debt instrument, and our interest revenue right off the amortization table. And the same thing for the end of the year 2024. Pretty straightforward, I think, there. So now, if we take a look at the determines that the fair value of the bond is $105,000 and the carrying amount is $106,732, you get that from the amortization table. We can go back. Here's the $106,732. Oops. And so now, what entry would you make to record the unrealized gain or loss? So what we would do is we would subtract 105,000 from the 106,732. We get $1,732. That's our unrealized holding gain, loss here in this case. So it's a debit, and the fair value adjustment is $1,732. Okay, so then we report that on the balance sheet like this. Our investments are going to show the debt investment net of that unrealized holding gain or loss, and then the stockholders' equity is going to show $1,732 of accumulated other comprehensive loss. Now, Webb Corporation has two securities classified as available for sale. The following illustration is going to identify the amortized cost, the fair value, and the amount of the unrealized gain or loss. And here they are. The amortized costs total $293. The fair value a little less than that at $284,000. So the unrealized loss is $9,537. So we're going to make a fair value judgment, which is a credit here of $9,537. All right. So this looks like a good place for us to stop this video. And when we return, we'll take a look at the adjusting entry to evaluation allowance to record the decrease in value at the end of 2025. Until that time, bye for now.